The Federal Reserve wraps up its March policy meeting on Wednesday, and here with a preview of the Fed's statement is Steve Blitz, the chief economist at ITG. So, Steve, it's pretty safe to say, no rate hike this time around.
No rate hike.
But give us a sense of what we should expect in terms of sentiment on the statement.
Well, I think that's the key thing. People, when you look at whether or not the Fed goes or doesn't go, really misses the point. The real point of the Fed tightening and easing is what occurs in all the forward curves. And that's basically the market pricing in its expectation of what it thinks the Fed policy rates are going to be 6 months, a year, 2 years, even 3 years out. And while that might sound like a very esoteric inside baseball kind of thing from a market perspective, or I should say coming from a market perspective,
right,
it really isn't, because those are the yields that affect financing on car loans, on mortgages, on corporate credit. So it is important. And when we look back over the last now almost 2 years, we see that the economy did slow and the equity markets did underperform as the market put in a very high level for this world, a very high level of forward funds rates.
And when you look at the January statement a couple months ago, the concern at that time was fears about a global recession, largely stemming from falling oil prices and the slowdown in China. Perhaps this time around we'll have a little bit more of an optimistic view from the Fed when it comes to the global economy?
Yeah, and in fact, building on my point about the forward rates, effectively what the Fed did in its statement in January was tell the markets that this easing that it had done in its expectations of what the Fed would do was okay with them. With this meeting, yes, you're right, there's a little bit more stability in the underlying economy, at least the numbers are showing more stability. The equity markets have clearly stabilized and rallied back from the lows. And so while they won't move, they'll probably show a certain amount of optimism, and with that they will put back into the market, or confirm at least what's already been put back into the market, a schedule of tightening. Now the issue is how much, and that's why their guidance in that regard will be much more important than what they actually do or don't do, and as you said, they're not going to do anything.
So that could perhaps set the stage for a June rate hike, which the markets are now pricing in.
Right, and that's exactly correct. And they will put in for that June hike. They will put into the marketplace a sense that a June hike, unless data dependent, unless the world falls apart, right, between now and then, that they will go in June. The real issue is what happens in September, December next year and the year after, and how aggressive does the market think they're going to be to get to some target level of the funds rate within a certain amount of time. And it's that pricing that really matters most to market behavior, and it does impact real economic growth.
And speaking of data, we got a little bit better inflation reading a couple weeks ago. Core PCE up 1.7%. But of course, we'll be watching this. Steve Blitz from ITG, thanks so much for coming by.
Thank you.
I'm Scott Gamm, and you're watching The Street.